Hello, Graviton team. I have made a finance project, two finance project. One is the financial model and second is the predictive models. So let's start with the financial model. I have made financial model with the name of the company known as Nava. So let's read about Nava, what Nava do. So Nava, full name is Nava Bharat Venture Limited, was established in 1972 and their main business is in energy. They have a 75% in energy. They produce energy in different part of country and plus they have 19% ferro alloys and 6% mining in coal, largest coal mining. And they also have other businesses in healthcare, agri businesses, agriculture businesses, and so on. So I'm going to create a financial model for the company known as Nava, and we will see either the company is overvalued, undervalued, and what are the financial metrics which we can use while analyzing a company. So this is the model which I have created. I have used 12 essential parameters that is known as one pager profile, historical statement, ratio analysis, common size, forecasting, beta regression, WACC, intrinsic growth rate, DCF modeling, comparable companies valuation, bar and Monte Carlo ratios, and the last one is DuPont analysis. So let's go to each page one by one and see what are the components and what are the metrics which we have used in the each of the components. So the first is the let me zoom it. The first is a one-pager report. It is a brief financial summary of the company, usually in a single page format. That's why it is known as one-pager profile. Okay. It contains key ratios like revenue, trends, profit margins, and valuation highlights, which you can see the capital structure, the shareholder patterns, the volume, the share price, and about the company also. And we also have the essential ratios, key metrics, and we also write the top 10 shareholders of the Nava company. So, and what are the future visions of this company? So it is used by the investors basically or executives who need to know a quick snapshot of the company's financial. So this can be used by them. Second, I have created a historical statement of account three main accounts, that is income statement, balance sheet, and cash flow. So here, why we used to create this? So it is basically essential for forecasting future performance based on the past trends. So as we know, we need to forecast the future outcomes. So we have created past performance statements so we can easily forecast in future. Like in the next sheet, if we will do any forecasting, we need the values. So we need to provide in a good way that so from that we can extract the values. Next, we have the ratio analysis. Ratio analysis is very important. Here we calculate profitability ratios, liquidity ratios, and efficiency ratios, and turnover ratios, debtor ratios, and CFO cash from operating ratios. And it helps in knowing a company's financial health and stability. It is also used by investors, creditors, and management team to compare companies with their industry benchmarks. So ratio analysis is really good. So I made a whole ratio analysis sheet in which I have first created the growth, then the margins, then sales, then अपना return on equity, return on earning and everything, turnover ratios, debtors ratios, days cycle, cash conversion cycle, and all the cash from operating ratios important points. Then I have a common size statement. Convert financial statements into a percentage format where each item is shown as a percentage of the total revenue. Allow for easy comparison between companies of different size. So for example, if I compare Nava with any other company which is bigger than Nava or smaller than Nava, so common size statement would be a easy metrics to compare because it has converted all the values in percentage. And same we can do with the other company where we can calculate their all the metrics or all the statements into a percentage. So we can easily compare the companies which is bigger, which is doing a better business in terms of percentage. Next, we have forecasting. Here we actually use historical trends and assumption to predict the future revenue, cost, and profits. And it is essential for the investment decisions and growth planning. This only tells that whatever the future predictions would be. So like I have created four forecast financials. Like first is sales, second is EBITDA, third is EBT, and fourth is EPS. So here we have predicted what would be the upcoming 5 years revenue for sales, earning per shares, or EBIT or EBITDA would be. Next, we have beta regression that measures a stock risk and volatility compared to the overall market. And it contains a regression analysis that calculates beta based on the historical stock prices and the market. It helps the investors to understand how the risky the stock is compared to the market fluctuations. So for example, if we want to know ki Nifty move, how much a Nifty or a like Indian benchmark is Nifty, that's why I said Nifty, how much a Nifty would move in comparison to the stock, like how much So it basically tells that how much a stock would move in comparison to the Nifty. If Nifty moved by 10%, how much the stock would move in comparison to the movement that a Nifty shows. So that's our beta regression. Next, we have WACC, weighted average cost of capital, and it calculates the company's overall cost of financials, which include cost of debt and cost of equity. And the analysis tells that a lower WACC indicates a cheaper cost of capital, which is a good for business growth. It's simple. If we have a lower percentage of cost of capital and we are earning more percentage in a business, then but obviously we would be retaining a good amount of profits in our company. So that's why it's always said, and investors are used to be satisfied if a company has a lower cost of capital and a higher rate of returns. So that's our cost of capital. Next, we have intrinsic growth value calculations. That's the sheet. Here we calculate first return on invested capital. Here we get to know how much return we actually generated by the capital we have invested. And second, we calculate the return on reinvestment rate. How much we are reinvesting in a business from the capital generation. And according to that only we get a growth rate by multiplying both the factors, and we get the growth rate. And growth rate tells that how much a business earns without taking or financing any money from the external sources. So automatically growing on itself without getting finance. So here the growth rate is actually 7.14, which is actually really good. Now we have the DCF valuation. That is one of the most widely used valuation method for estimating a company's worth. So let me tell you what is valuation. Valuation is basically getting a value of a company share price and comparing it to its price of the share, and then we get to know either it's undervalued or lower valued. Let me explain you with an example. Like for example, everyone knows a company known as Tesla, and for example, if Tesla is of $400, and if we do a DCF valuation on that company and we get to know okay, it's actually $600 valuation, so we got to know okay, Tesla is basically comparatively lower valued or undervalued share, because currently it is at 400 rupees and it should be at $600, sorry. So basically this is the power of DCF valuation. We get to know what is the real value of the share and what is the market value of the shares. Here I have done a DCF valuation where you can see according to our price it is coming 1200 rupees, but actually the share price is going at 404. It is going on a discount price for now. So it is not a directly predictive models DCF, but we can use it to know the what are the parameters which are going strong or which are going weak. And while making a DC evaluation, we also make many assumptions of percentage, values, parameters. So every time everyone can't have the same value in DC evaluation, because some person use different assumptions. I have used my assumptions, so that's the difference which we can see in my DC evaluation and in other DC evaluations. Next, we have the comparable companies valuation. So comparable comparable company valuation is used for companies financial to compare it with the peers companies financial in the same industry. It helps in estimating the whether the company's stock price is overvalued or undervalued compared to its peer. So basically it is using three essential valuation: EV by sales, enterprise value by sales, EV by EBITDA, and P by E, price to earning. So just comparing that how much we are standing on the comparable companies valuation, and if we are undervalued to our peers or if we are overvalued to our peers. Next, we have the Monte Carlo simulation. It is a probability model which simulate different financial scenarios, and it also helps us to manage the risk by predicting the likelihood of different outcomes. And it is helpful for investment decisions by analyzing the impact of market uncertainties. So it actually analyzes the different uncertainties which can come up during the market hours, and it tells us what percentage of risk management we should take while taking a trade in the market. And at the last, I have the DuPont analysis. DuPont analysis break down the ROE into three components. As you can see, I can show you ROE into the three components: profitability, efficiency, and leverage. Why we used to do that? Because it help in identifying whether the higher profitability are due to good operations, actually companies earning money, or due to excessive debt, the amount they are financing from the outside sources. So actually DuPont analysis is really good. I've written all the analysis of DuPont outcomes. You can see, and this is the last component which we have used in our financial model. Making this financial model show you that I know I have good knowledge about finance, and I understand different ratios, different analysis, different forecasts, and I have made this whole model in an Excel sheet and then converted into PDF. I will share this PDF link with you guys, and I will make a next video for a predictive models. Please go and watch that also. So thank you.